Hey everyone, in the previous video we discussed the confluence between the timeframes and we realized that even if we have a bearish or bullish impulse on a given time frame, after the pullback starts, we can have counter structure built on lower time frames. So schematically, if you will look on this bearish impulse and then you look inside here, you will see that on the lower time frames you will develop bullish structure, and then even though you can still expect this bigger structure to hold, it's better if you will find confluence on lower time frames and then even on lower time frames. So it depends on you and on backtesting that we will do later, what kind of confluence you want, like one level or two levels. So I personally like to have three confluences, so between like relatively distant time frames. Okay, and in this video we will discuss a basic theory of trends. So what is a trending market, what is a bullish market, bearish market, and so on. So let's first start with a schematic like we like to do. And imagine some kind of a neutral market, so some kind of range. So just nothing happens here. And then the market starts a bullish move. So at this point, we will have this one bullish break. Is it bullish or bearish sign? So yes, it's a bit bullish, but for really bullish market, we need to have a second shift of structure. So this all comes from this classic Dow theory, that when you have like two shifts of structures, the market can be considered bullish, with some exceptions, of course. So this course is built like step by step, and then the more you know, the more puzzles, the more parts you can put together. But for now, that's already a good start. So if you have a market that have two shifts to the upside, you can say that this is a bullish market, and you are more clear on the direction. And even if the inside structure will play around a bit, you can still say that you are expecting this range to hold and expect a third break and so on. But with this concept, what we can add to it? So we can add this really common pattern that when you have two shifts of structure and then one shift to the downside, this market is still considered pretty bullish, relatively bullish, even with one shift of structure to the downside. And I will explain a bit more about this, but basically this is known as reaccumulation, and we can still expect this lower, so this range failed, but we can still expect this range, this low, to hold, and we can still look for confirmation inside there. So this is like a basic concept that you can use to formulate your bias, your context. And again, we will talk and work on practice with it while we will backtest and while I will comment on some situations in the market during the course. Now, what can happen? And again, there are different scenarios that can happen during the price action, and it makes sense to know as much of them as possible, but we will start with this basics one. So remember, if you have two shifts, that's relatively bullish, and even if you will have one shift, you can still expect this protected low to hold and give you even more bullishness. Now so this was like the first part, like two shifts, then second part, one bearish shift, and then third part. If the market will continue to break and give you like one, two bearish shifts, now all the structure to the downside will be irrelevant. Okay, so irrelevant for bullish price action, and it will be more likely, to be just a liquidity target. And so why I'm mentioning about it? Because usually what people do is they say, oh, the market is going down, but this is like some kind of support, or this is my zone, and so on and so on. But if the market is starting to go bearish, now it's a bearish market, and these levels will be liquidity targets for it. Okay, so just remember these overall basic scenarios of how the market tends to move. And by the way, this is this is what happened, let's say here on lower time frames. So you had a break, then the market starts to go bullish on lower time frames, and now it's shifting bearish. Now all these lows will become just a target for it to meet higher time frame ranges. Okay, so we discussed this. And one more thing for you to understand. Sometimes a market just can do, so it can break even 2 times and then shift back again to the bullish side. So it can happen again because the market structure is complex. And even though I mentioned that these are more likely targets, but we are still in this big move on higher time frames. And then combining different zones, combining the understanding of the market, sometimes it makes sense to expect some bullishness, but of course it does not mean that you will buy directly from every zone, every level. You will actually wait for bullish shifts, and then while you have this higher time frame structure aligned with this specific time frame structure, you are also, let's say this is a weekly push, and then this is actually daily structure we are looking at. You will wait for reshifts back to the bullish side, and you will understand that yes, we shifted bearish, but this is like a deeper reaccumulation. We are still inside this bigger impulse, and we can still wait for this high to be taken out. Okay, so really trends and these all developments can be more complex if you want them to be. And again, remember, you have a shift, you can expect something like this, but then continuation back. And then usually what market does is, after several cycles of such redistributions, in this case, it can go for back and forth for some time and then shift the trend. So this is the next topic of this video, how the trend changes. So a big problem with many traders is that when they see like a strong bearish market or a strong bullish market, they expect every time the trend to change like this, so in a V shape, you know. And then what they do is they trade against the impulse. They try to buy this bearish impulse, and they expect this huge beautiful move that will fulfill their dreams and whatsoever. But usually the market does not change a trend like this. Usually it will shift structure multiple times. So even it will show you like 2 shifts to the bullish side, but then usually it will break even more and just go back and forth for some time. It will perform an accumulation, and usually it happens after we had some redistributions before. So the market started, like a lot of people can consider this as a start of a bullish trend, or this one, and then maybe on the third cycle it can perform an accumulation. These cycles can be repeated many times, but usually not more than 7 or 5, 7. If you have like bearish trend, and then you notice that you have one redistribution, second one, third one. So on the first, on the fifth, you already can expect either a deeper redistribution or really a change of a trend in a form of back and forth structural changes. And again, this is this video is more like based on theory, but you just listen, and then when I will comment on it on the market and on backtesting, you will have a reference to what I'm telling here. A quick example on a real chart, again without references, without strict reference to the structure, but looking overall at how the market moves, can be found like this. So a market that is moving down then creates a redistribution. So maybe take something here. but continues the overall move. So you see, we had this bigger move that actually held. Then continued bearish move, created like a shift of structure, break, then a small redistribution, and even a second shift to the upside, you see? And for a lot of people, this is a huge shift in the market behavior. And by the way, it can work out, but usually it just continues to the downside like it does here if the market is really trending. So it shifts, then back bearish, starts a cycle of its structure, then maybe performs a deeper redistribution. So let me show you. So this is a redistribution, this one is a bigger one, then again continuation of a trend, maybe this smaller one. So you see 1, 2, 3, 4 cycles, and then bigger move. And now what's interesting, again, we have 1, 2, 3, like 4 or even 5 shifts to the bullish side, so a more sustained bullish shift, and now it breaks down. So again, for me, until this bigger leg will hold, this market is even more bullish than it's bearish. Why? Because we already had a lot of cycles of redistributions, and now it's okay to expect at least short-term in relatively to this time scale, short-term bullish trend, or like we can say, it can do a redistribution inside of this bigger monthly or weekly leg. Okay, so this is a quick example how you can apply these concepts. And now the last thing for this video is, let's talk about how the market can be considered relatively overextended. And this is pretty simple. When you look at the market, so imagine you have some bearish price action and then you started bullish price action. So the market will usually, actually it never moves like indefinitely in the same direction structurally. What the market can do? The market usually can perform like 3 or 4 breaks to the upside, and after the fourth break, again, it's not fixed number, okay, it's just approximately like 3-4 breaks. We already can expect some reaccumulation in this case. So we can actually expect for the structure to break once or twice before continuing to the bullish side. The market can do so. Usually the maximum number of these consecutive shifts without any kind of structural reaccumulation, usually it does not exceed like 10-12 shifts. Okay, so when you see a market that has like 10 or 12 shifts on a given time frame, and the more it has, the more confident you can be that we are close to reaccumulation pattern. So we need to make some breaks structurally and then maybe continue. So you can use it in 2 ways. So first of all, and this is what I recommend, is when you're looking to trade, if you have a market that has like 5-7 consecutive shifts, don't trade this structural range. Don't expect it to hold too much. Only if the lower time frame structure is really clear. Because now you understand that the market is relatively overextended, and it's better to wait for this shift to the bearish side and then look for newer shifts before going to the bullish side again, because you understand that you are still overall bullish. And these patterns, they play on different time frames, like high time frames, middle time frames, and so on. Okay. So this video is more based on theory, and you will see how we can use these patterns in the next videos. And by the way, yeah, 2 videos ago I said that we will discuss supply and demand zones, but then I decided to record the videos about confluence and about trends and trend changes. Okay, see you in the comment section. Send your questions and your comments. How is it going? If you are confused, if you are not confused, maybe you will even have some personal requests or whatsoever. I will be glad to hear from you.